Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by hitting the subscribe button, and feel free to leave your comments. All right, let's check the analysis.
$740. That is the number on the screen right now. If you were watching the regular trading session on January 28th, 2026, you saw hesitancy. You saw a closing price of, what, $672.36, down just over 0.5% on a volume of about 14.6 million shares. But the second the bell rang, well, the real market woke up. We witnessed a massive surge in after-hours trading, skyrocketing more than 10%, shattering the 52-week high proximity and, effectively reclaiming every inch of technical territory lost since mid-last year. If you pull up the daily chart, that is a textbook bullish W formation. The market has digested the news, and the verdict is euphoric.
Euphoric is the right word, but I'd use it as a diagnosis, not a compliment. You are blinded by the after-hours glow and completely ignoring the reality of the actual trading day, where the liquidity, actually lives. The market was nervous for a reason. Implied volatility, essentially the market's pricing of fear and expected movement, was sitting in the 68th percentile. That is incredibly high for a company of this size. The option market was pricing in a $50 swing because the risk here is palpable. You see a breakout, I see a stock that is becoming unhinged because the underlying business model is undergoing a, frankly, terrifying shift in capital intensity.
It is a shift. Absolutely. But calling it terrifying, I think, misses the historical context of what we are watching here. We are witnessing the pivot from the year of efficiency, which everyone loved, by the way, to the era of infrastructure. And yes, volatility is the price of admission. Meta just dropped a capital expenditure forecast that changes the entire landscape of Silicon Valley, guiding $115 to $135 billion for 2026. This isn't just spending. This is, the construction of a global intelligence utility.
A utility? That is a very expensive euphemism for burning cash. Let's look at that number again. $135 billion. That is nearly double the 2025 capex of $72 billion. That is more than the GDP of entire nations, effectively, set on fire to chase a superintelligence dream that doesn't exist yet. And the cost? Your precious operating margins are getting crushed. The market's regular session hesitation was the rational response to a company saying, "Trust us, we're going to spend everything we have." The after-hours move is just algorithm-driven noise chasing a headline revenue beat.
It is not noise when it is backed by a 24% revenue beat. But let's lay out our stakes clearly right now. I am looking at this data and I see a company successfully transitioning into the single most important infrastructure play of the decade. The smart money accumulation is undeniable, and the revenue growth proves the core business, the family of apps, is a cash cannon strong enough to fund this massive bet without even blinking.
And I am looking at the same data and seeing a reckless disregard for shareholder capital. You have margins compressing, you have insiders selling like the building is on fire, and we will get to that, and you have technical indicators that are just screaming that the stock is overextended. This isn't a utility. It is the biggest gamble in corporate history.
Then let's get into the details, because the gamble is already paying off. Let's start with our positions. My thesis here is simple. The market is correctly looking past the immediate cost to the, inevitable growth. We just saw Q4 2025 revenue hit $59.89 billion. That didn't just beat expectations, it crushed the consensus of $58.35 billion. We are looking at an earnings per share of $8.88. The core advertising machine is healthier than it has ever been.
Revenue is vanity, profit is sanity.
And the trajectory is sanity. That bullish W pattern I mentioned, coupled with the reclamation of the $740 level, signals a major expansionary phase. The era of infrastructure isn't waste. This capital expenditure is building a moat that no startup, no matter how well funded, can possibly cross. We are talking about the physical infrastructure required for artificial general intelligence, or AGI. When you have a company growing revenue at 24% year over year at this scale, you don't penny pinch on the server racks. You build the future. The market sees a company that is going to own the rails of the entire AI economy.
Hold on. Owning the rails implies you can charge a toll. Right now, they are just building the tracks with no guarantee a train is even coming. My position is that the financials are degrading and rapidly. You are celebrating revenue while ignoring the collapse of profitability efficiency. I mean, look at the operating margins. In Q4 of 2024, Meta boasted a 48% operating margin. Okay? In Q4 of 2025, that plummeted to 41%. That is a 700 basis point contraction in a single year. Do you realize how massive that degradation is?
It is a necessary investment phase. You can't have infinite margin expansion while pivoting to a new hardware paradigm. It's just not possible.
It's a hemorrhage, and it is about to get worse. If they hit that $135 billion spend target, margins aren't going to stabilize. They are going to crater well into the 30s. And look at the technical danger zone we just entered. The Post-Earnings Relative Strength Index, the RSI, hit 83.15. Now, for listeners who don't stare at charts all day, anything over 70 is considered overbought. An RSI of 83 is severely overextended. It implies the stock has moved too far, too fast on hype rather than fundamentals. While you look at the after-hours price, I look at the regular session, where investors took a wait-and-see approach because the risks are rising, not falling.
I think you're misinterpreting the margin compression. It's a feature, not a bug, of this specific transition period. But we need to dig into the core debate here. You call it a capital shock. I call it the infrastructure gamble. But it is a calculated one. We need to talk about exactly what that money is buying. This isn't just cloud spend or, buying vague software licenses.
Please enlighten me. Where exactly does $135 billion go in 12 months?
It goes into physical assets that solve the physical limitations of deployment. We aren't just buying chips, we are building cities of compute. Look at the Titan clusters. Specifically, we have Project Prometheus in New Albany, Ohio. That is a 1 gigawatt data center supercluster coming online in 2026.
1 gigawatt? Do you understand the scale of that? 1 gigawatt is roughly the energy consumption of 750,000 homes. You are dropping a facility the size of a medium city's power grid into Ohio.
Exactly. That is the moat. Anyone can buy an H100 chip. Only Meta can deploy a gigawatt-scale cluster. And that's just the start. Project Hyperion in Louisiana is designed to scale up to 5 gigawatts. I mean, this is unheard of.
It's unheard of because the U.S. power grid is already straining. You can't just plug a supercomputer into the wall. The lead time on substations, transmission lines, and cooling water is measured in years, not quarters.
Which is why the spend covers the energy unlock. On January 9, Meta announced nuclear energy projects, unlocking 6.6 gigawatts of power. And then on January 27, they signed a $6 billion deal with Corning for fiber. This is vertical integration. They are securing the energy and the connectivity that everyone else is going to be fighting over. These are hard assets. This is the foundation of Meta Superintelligence Labs, or MSL. They are building the factory for the next century.
Okay, let's pause on the nuclear point. Announcing a nuclear project and turning on a nuclear reactor are two very, very different things. Nuclear regulation in the United States is a labyrinth. You are talking about a timeline of 5, maybe 10 years for new nuclear capacity, but they are spending the money now. So you have this massive cash outflow for assets that might not turn on until 2030. In the meantime, you have to run these clusters on something.
They have bridge power solutions. But the point is the ambition.
The ambition is writing checks the grid can't cash. And I'm sorry, but I just don't buy that bigger is automatically better. You're talking about building these Titan clusters, but are you looking at who is running them? The costs here aren't just concrete and fiber. It's the talent war. We're seeing reports of recruiting packages hitting $300 million over 4 years just to poach researchers from OpenAI and DeepMind.
Talent is the scarcest resource. You pay what you have to pay.
That is unsustainable wage inflation. $300 million for a researcher? That distorts the entire OpEx structure. And let's look at the ecosystem this money is flowing into. It is a circular financing model, and this is dangerous.
Explain what you mean by that.
It's a house of cards. The hyperscalers like Meta spend billions buying chips from NVIDIA. NVIDIA books that as revenue, their stock soars. NVIDIA then invests in AI startups, or the ETFs that hold Meta go up because the sector is hot. It looks like growth, but it's really just capital recycling. Meta buys chips to train models that they give away for free via Llama, hoping to monetize. something, eventually.
They aren't just hoping, and regarding the hardware, you're missing the supply chain reality. You mentioned the Corning deal, but the real bottleneck is CoWoS.
Chip on wafer on substrate.
Right, the advanced packaging that TSMC uses to actually stack the memory on the GPU. You can have all the silicone you want, but if you don't have the CoWoS capacity, you have a paperweight. The supply for 2026 is already sold out to the Tier 1 players. Meta has secured this. Just because they are spending $135 billion doesn't mean they are throwing money at a wall. It means they are the only ones who can actually get the hardware.
Being first in line to buy overpriced hardware doesn't guarantee a return on investment. It just guarantees you spend the money first. And frankly, just because Meta wants to deploy $135 billion doesn't mean they can do it efficiently. Bottlenecks in high bandwidth memory, HBM, are real. If SK Hynix or Samsung have a yield issue, Meta's deployment schedule slips. But the depreciation costs on those half-built data centers start immediately.
You're focusing on the execution risk, which is fair. But let's pivot to how this looks relative to the competition. You mentioned the margin compression, but look at the valuation. Meta is trading at a forward price-to-earnings ratio of, roughly 22.7x.
Which is a premium to Alphabet.
Only slightly. Alphabet is at 20.1x. But compared to Amazon at 28.2x, Meta's offering a better value proposition than Amazon with significantly higher margins than Amazon, even with the compression. And look at the balance sheet. Return on equity is nearly 38%. Debt to equity is 0.26. This is a fortress balance sheet. They can afford the $135 billion spend without leveraging themselves into oblivion. They are cleaner than their top peers.
Valuation is relative to risk, not just relative to peers. And the risk here involves their frenemies. We need to talk about the hardware triangle they are trapped in. You talk about partnerships like they are stable. Look at Arista Networks.
A great partner.
They were a great partner. Meta and Arista co-developed the Disaggregated Scheduled Fabric, the DSF. Essentially, the plumbing that lets servers talk to each other without using NVIDIA's proprietary cables. Great, but Meta is also the lead customer for NVIDIA Spectrum X networking.
They are diversifying. That's smart.
Adopting Spectrum X, Meta is strengthening the monopoly of their biggest supplier, NVIDIA, while undercutting their networking partner, Arista. They are caught in the middle of a hardware war. If they lean too hard into Spectrum X, they alienate Arista. If they stick with Arista, they might miss the performance gains of the full NVIDIA stack. It's a mess.
It's leverage. They are playing both sides to get the best price and performance. That is what a utility does. It treats suppliers as interchangeable.
But these suppliers aren't interchangeable. NVIDIA is a monopoly. And please, let's stop comparing them to social media peers. I keep hearing comparisons to Pinterest and Snap in the analyst notes.
They are the leaders of that sector.
They shouldn't be in that sector anymore. You can't praise Meta like a social media company if it spends like a utility. Pinterest trades at 13x earnings, but they don't have a $135 billion CapEx risk hanging over their head. Snap is expensive but irrelevant. Meta's in a category of one, and that lack of a clear peer group makes the valuation tricky. You say 22x is cheap. I say for a company compressing margins by 700 basis points, it might be a value trap.
Well, I'm not convinced by that line of reasoning because the smart money clearly disagrees with you. We need to talk about the market mechanics, the plumbing of what happened in January. You think the regular session told the story? Look at the dark pools.
Here we go with the dark pools. It sounds like a conspiracy theory every time you bring it up.
It's not a conspiracy, it's market structure. FineRed data shows that between 47% and 50% of the volume for Meta is happening off exchange. Half the trading volume is hidden from the public tape until it's printed. That is institutional accumulation happening quietly to minimize price impact. We saw volume bursts of $9.5 billion across tech stocks right before earnings. That is the whales positioning themselves. They knew the beat was coming,
And hear me out, that off-exchange volume was hedging.
if they were hedging, why is the short interest so low? Only 1.5% of the float is short. The days to cover is barely over 2 days. If the smart money thought this $135 billion spend was a disaster, they would be shorting the stock. They aren't. They are terrified to bet against Zuckerberg. And look at the prediction markets. This is fascinating. Polymarket.
The gambling site?
The information market. Before the earnings dropped, the crowd on Polymarket gave a 61% probability that Meta would hit $700 in January. They were right. The wisdom of the crowd was ahead of Wall Street. The InfoFi traders saw the tea leaves better than the Goldman analysts.
That's a compelling argument. But have you considered who is actually selling? You talk about the smart money in dark pools and the wisdom of the crowd on Polymarket. I prefer to look at the people who actually have the keys to the building, the insiders.
Executive selling is standard. They have 10b5-1 plans. They have to sell to pay taxes.
This goes way beyond standard tax planning. Mark Zuckerberg has sold stock 131 times in the last 6 months. That's $110.6 million taken off the table. Susan Lee, the CFO, the woman who literally gave that bullish guidance on the call, is selling. Javier Olivan, the COO, selling. Do you know how many open market purchases there have been by insiders in the last 6 months?
I assume low.
0, not low, 0. Not one executive thought, hey, we're about to become an intelligence utility, I should buy more shares. If the future is so bright, why is the leadership team cashing out every single day?
Because they are already historically concentrated. Zuckerberg's wealth is entirely tied to the stock. It would be irresponsible for him not to sell some.
When the CFO and the CEO are selling into the rally while telling you to hold on for the infrastructure era, you should listen to their actions, not their earnings call script. And it isn't just them. Look at Congress. Representative Lisa McClain was a seller back in October. Sure, you had Mullen and Larson buy a little bit, but the internal signal is flashing bright red.
The congressional trading is mixed at best. I wouldn't trade based on what Lisa McClain does. But I want to go back to the options market for a second. You dismissed the bullishness, but 94% of large trader activity was focused on call options. We saw block orders for strikes at $670, $750, expiring in March and September. That isn't retail speculation. Those are massive institutional bets on upside continuation.
Or they are call spreads designed to cap upside while generating income. Or they are hedging a massive underlying short position that you can't see because of the dark pool complexity you love so much. The fact remains, the RSI is at 83, the stock is historically overextended, and the margin of error when you are spending $135 billion is 0.
The margin of error is buffered by a $200 billion revenue stream. Look, the bullish W pattern is technical confirmation of a fundamental shift. The $740 break changes the psychology of the stock. It clears out the overhead supply.
It clears out the bag holders from last year, giving them a chance to exit. That's what a double top often looks like before the fall. You were betting that Project Prometheus comes online without a hitch. You were betting that nuclear regulation doesn't stall the 6.6 gigawatt unlock. You were betting that the circular financing model doesn't collapse. That is a lot of ifs for a company trading at near record highs.
And you were betting against the single most effective capital allocator in Silicon Valley history. Zuckerberg pivoted to mobile when everyone said he couldn't. He pivoted to stories to kill Snapchat. Now he is pivoting to AGI. The $135 billion isn't a cost. It's the barrier to entry that keeps everyone else out. We need to visualize what this personal superintelligence actually is.
I'm listening. What is it?
It's not just a chatbot. The goal of Meta Superintelligence Labs is to create an AI that knows you better than you know yourself. An agent that lives in your glasses, sees what you see, and handles your life. That requires compute that doesn't exist yet. It requires the Titan clusters. If they pull this off, they don't just sell ads. They sell the operating system of existence. That is worth $135 billion.
He also pivoted to the metaverse, which cost billions and yielded legless avatars and empty virtual rooms. We cannot just forget that misstep. This intelligence utility rhetoric sounds suspiciously like the metaverse rhetoric of 2021, just with a much higher price tag. An operating system for existence? That sounds like science fiction. Shareholders pay for science fact.
The difference is the revenue is already here. $59.89 billion in a single quarter proves the core business is stronger than ever. The AI is already improving ad targeting. That's why revenue is up 24%. The infrastructure is paying for itself in real time. The metaverse was a dream. AI is a revenue driver today.
It's paying for itself now, but if that margin compression continues, if we see operating margins dip into the 30s because CapEx spirals out of control, the street will not be forgiving. You mentioned the 700 basis point drop. If that trend holds for 2026, the earnings growth evaporates. Even if revenue climbs, you end up with a company that is bigger, busier, and poorer.
But the guidance says operating income will be above 2025 levels. They explicitly stated that. They are managing the spend while growing the bottom line. That is the definition of execution.
Guidance is just words. The checkbook is reality, and the checkbook says $135 billion is going out the door.
Let's bring this to a close because the lines are drawn pretty clearly. We are looking at a company that has shocked the market with its ambition. For me, the after-hours move to $740 is validation. The market digested the $135 billion guidance and decided it was worth it. The bullish W pattern, the massive dark pool accumulation, and the revenue beat all point to a stock that is heading to new highs above $796. The intelligence utility is the future, and Meta is building it.
And I look at that same future and see a path fraught with financial peril. You cannot simply ignore a 700 basis point margin compression or an RSI of 83. The risk-reward here is broken. The transition to an intelligence utility might succeed technically. They might build the best brain in the world, but it could fail the shareholders financially if the return on invested capital is delayed by even a few quarters. The insiders selling their stock know this better than anyone.
It seems we agree on the stakes, if not the outcome. The critical watch items for 2026 are undeniable. We will both be watching the activation of the Ohio Prometheus cluster.
Absolutely. If that 1 gigawatt cluster goes online on time and on budget, I might change my tune. But if there are delays or if the personal superintelligence remains a novelty rather than a revenue driver, that $600 support level is going to be tested very, very quickly.
And if the monetization of that superintelligence takes hold, $796 will look cheap. There is certainly more to explore in this material as the year unfolds.
Complexity always requires multiple perspectives. It's going to be a volatile year.
That's the only guarantee we have. Thanks for listening.
Thank you for watching the video. Remember to subscribe to the Stock Market Palantir channel for more stock analysis like this and leave your comments below. See ya.